What's up, everybody? It's your boy, Brandon, back with another edition of the Macro Insights Podcast. But first, before we get started, a little disclaimer. I am not a financial advisor, and the guest is not giving financial advice. So everything you hear on this podcast is strictly opinion and should not be taken as financial advice. We disclose if we have any holdings discussed in this podcast, and you should not be following us as financial advisors. You should discuss this with professionals before you get involved or invested. And as always, it's not financial advice. So please, please, please take this strictly as our opinions and for entertainment purposes only. Now let's get into the show. What's up, everybody? I'm back with another edition of the Macro Insights Podcast, where I have Kim, Mama Vester, who focuses on market psychology, futures, options, and has a long-term portfolio. So we're going to talk about everything that she's seeing in the market, all the crazy things that are going on. We're going to break it all down for you. But first, big shout out to my sponsors. Shout out to Pleb Lab down in Austin, Texas. It's the #1 hacking space in the country. If you haven't been down to Austin, you need to go down and check it out. They got a lot of great events. They have a Noster Devs course right now that is off and running. It's an 8-hour course. You could start and become a Noster Dev for some open source social media if you would like to. And it's only 8 hours. You can start from like no coding background and become a master dev. So you be sure to check that out at pleblab.com. Also, shout out to Idaho Armored Vaults. Bob Coleman and team have been offering some of the lowest spreads, if not the lowest spread of any single precious metals dealer that I've seen in the entire United States. So go to goldsilvervault.com, contact Bob and his team, and get yourself started so you can get investing in precious metals. Usually we see, if you go and look at the historic gold and silver charts throughout the entire year, obviously it's not investing advice or anything like that, but you see, it usually takes off to the second half of the year. So maybe it's time to get in. So call up Bob and his team to see if it's a good fit for you. And that's enough from just me. Let's get Kim up here. Kim, how you doing today?
I'm doing great. Thank you so much for having me.
Yeah, thank you so much for coming on. We got introduced on a space thanks to Wolf. So shout out to
Yeah,
Wolf. And
he's amazing.
yep, the great spaces that he puts on. But for those who don't know yet, why don't you tell us a little bit about your investing background and kind of how you got started investing?
So I have always loved the stock market. I've been interested in the stock market since I was probably like 15 years old. I don't remember exactly what got me interested in the market, but I'm from the generation Gen X where we still had newspapers and I would look up ticker symbols. Back then it was Nordstrom. I'm from the Seattle area. And so Nordstrom was kind of our like #1 firm or business here, as was Boeing. And so I would look up those ticker symbols, but I didn't really know how to invest then. You had to go through a broker, there wasn't access. So that's kind of where I started my interest. And then later in life, I just started investing. I would read Money Magazine. I would invest, my $100 a month. I would had a stockbroker. I was like an early investor, not early, but kind of early into Costco. And that was the time that Microsoft really started taking off and people were making a lot of money, like owning those stocks. So that was kind of like my history of how I got interested. But I wasn't individually trading yet.
All right. Well, yeah, then tell us kind of where you're at now in your investing journey. Like, I kind of listed off some of the things that you're focusing on, but, where are you kind of, I guess, focused on right now? Obviously, we have a lot of market volatility. It's kind of been, stagnant. It seems like, some growth stocks have been taken off this year. So where are you kind of, looking at your portfolio and kind of analyzing things as of right now?
Well, really quick, I'll just say what got me interested in investing individually is about in 2018, I had an actual stockbroker and the market had taken a big step back. And my stockbroker didn't have good information about how to hedge your portfolio. And that's really what started my own interest. And then obviously with, online trading, it became easier to access trading. And so I got really excited about it. And the account that I had at my stockbroker, I ended up taking over. And so some of my original ways of looking at the market and that still hold true today is how do I stay long in positions because I'm a long-term investor, but help to protect my drawdown. And so a lot of that I use through option selling, through selling futures, obviously trimming if your portfolio gets too high, putting on different option strategies that help protect some of my downside. So I know that didn't quite answer your question, but wanted to give that little bit of history of how I kind of got to where I was today.
Yeah, no worries at all. But yeah, I mean, it seems like it's kind of an interesting time in the market, right? I mean, we've
Mm-hmm.
the 2020 boom, and then now it seems like we're kind of like floating along with certain stocks and certain companies like really taking off. And it seems like there's kind of like the dilapidated earnings reports, right? I mean, like their
Mm-hmm.
expectations are a little bit lower. So, I'll leave it kind of broad for you and a little bit more open-ended, but how are you kind of viewing the market right now? And like, what's your kind of, I guess, future outlook for maybe the next quarter or so?
Well, I have to say, in October, my husband came home and said, "You have to look at Chat GPT and you need to get invested in NVIDIA." So he has some people that he knows. I'm not going to name the companies, but he has some people he knows in tech. And I was like, "What's this Chat GPT?" Didn't really know what it was. And at that time, the market was still going down, right? In October, we were still having the correction pretty much through the end of December, beginning of January. And I say that because as I was being made aware of the AI theme and the Chat GPT, I did not recognize, I did get long NVIDIA, but not nearly like what you would have wanted to get long at that time, right? I didn't realize that we'd have this V-shaped recovery essentially. Hit the bottom, fly right off the bottom, literally in a straight line, basically for the last 6 months, except for the time when, the banks were kind of in that what do you want to call it, dilution from SVB and some of the other ones. But, basically it's been straight off the bottom. So I'm always long stocks. I'm a long-term investor, but I wasn't as long as I would have liked to have been. And now that we're kind of hitting this peak, I really feel like it's time the market's going to take a breather, take a step back. I can't predict, are we going to go up another, few hundred points in the NASDAQ, for example? But definitely, I think I'm being cautious. So I've taken some risk off the table and definitely have been putting hedges on, but at the same time, being really careful not to deploy that cash that I'm so eagerly wanting to because I had so much cash on the side. So trying to not get the FOMO. And I think that's the hardest thing not to do when the market's flying.
Yeah. So, I mean, like, how do you kind of, I guess, reel that back, right? I mean, it seems like there was kind of the FOMO craze, right, during COVID, right? I mean, everybody was
Hmm.
into the market with GameStop, and obviously there's a lot more, spread of information. Obviously
Hmm.
we met on Twitter Spaces. I guess it's rebranded to X as of today or yesterday, but
I
uh,
know.
how do
I'm
you
calling it Twitter for now. I can't get used to the X.
exactly. Like, I mean, I don't know. I'm originally from Chicago, so I still know that the giant tower downtown is the Sears Tower. So that's how
Hmm.
I kind of talk to, how I'm wording it to people is like it's Twitter. I don't know
Yeah.
what else to say. Like, I'm
And
not
the blue bird is like iconic, right?
exactly.
So I can't, X can stand for so many things, but the blue bird only stands for Twitter.
100%. Yeah, for sure. But, in this, obviously we have like a massive amounts of spreads of information, right? I mean, you talked about, just kind of like reading things in the paper previously. Now you can go on Twitter, search a stock ticker and see, a
Hmm.
bunch of people's different opinions. Everybody seemingly has like a Substack newsletter. There's Reddit, there's all these other
Hmm.
places. So, how do you avoid maybe the FOMO type of investing when it comes to, obviously like the massive amounts of information that we have now. And everybody's got an opinion on a certain
Yeah.
stock.
Honestly, what I do is I look for people that I trust because in the beginning, when I got on Twitter, like you said, social media, you don't know who are the pump and dumps. They're just literally trying to pump a stock, get people in it. They can, move these smaller stocks and then, dump them. And who are the real people to follow that have good information, that are trying to, that are authentic, transparent. And I think over time, you just learn to kind of shut out that noise. It's hard to do at first, but here's the thing, like you said, everybody has an opinion. So even the, people at JP Morgan or Goldman Sachs, they've all been wrong, right? Like they were all saying the market was going to go to 3,200, 2,900, worst crash ever. One piece of advice I have is tune out anyone says that the market's crashing tomorrow. That's number one. Anyone that says that you need to get in immediately, there's always time, right? You might miss some upside on something, but at the same time, markets always ebb and flow, right? You just have to be, for myself, I need to be patient and sit on my hands. However, there's always ways to take advantage of the market, right? So I use black box stocks. And I also, my two things are black box stocks and Tasty Trade. And I'm not sitting here trying to promote it. I don't get money for it, but that is what I use, option flow, right? So where I've not had enough cash deployed, what I've been trying to do is look at where are people putting their money. And what I'm doing is putting some money to work in different areas where I see money is going into. So those are more swing positions for me versus long-term positions. So I have my long-term investments, but then I'm trying to trade around that, right? Like, for example, I saw a lot of flow going into the IWM, which is the Russell 2000. And so what I did is I got long the RTY, which are the futures. I like doing that because there's no theta decay and there's no gamma squeeze. And I can also trade it 24/7 if I needed to for some reason. Like, let's say overnight, the RTY jumped 50 points. I can get out, or I can have my stop set or my buyback set. So when I heard that option flow go out on IDM, I wasn't going to, I mean, I'm sorry, IWM, I wasn't going to buy the index and I didn't want to buy the options, but I went long the futures. And that ended up being a really good swing trade for me to get some alpha in my portfolio, put some money to work, but then put that cash back to the side again.
Yeah, I got it. And then, that makes a lot of sense, when it comes down to it, right? Looking at the volumes, I mean, it just kind of makes sense, right? You're kind of just
Mm-hmm.
tracking the money opposed to doing that. But, you mentioned a little bit earlier about knowing when to get out and kind of like liquidate, which I think is always kind of like one of the more interesting questions. Whether it's kind of going in on options or whether it's like kind of a long-term investment, kind of how do you determine when is a good time to sell a stock, right? I mean, because it seems
Yeah.
like, some people who are long-term investors, they subscribe to the Warren Buffett theory, right? I mean, you should buy a stock with the intention of never selling it. But, sometimes there is a good time to sell it. And sometimes, you should really give that a better look. So, how do you
Mm-hmm.
kind of evaluate that situation and evaluate your portfolio as to when to liquidate certain positions?
So I have a core set of holdings: Apple, Costco, Microsoft. It's actually on Elite Trader Funding. Wolf talks about, not Elite Trader Funding, I'm sorry, Savvy Trader. I apologize. So my whole portfolio is up there in my, long-term investment account and my, not my trading account, not for options, but I have my core holdings. I look for those core holdings not to get above 7 to 8% of my total portfolio, right? So if I see, like, for example, Microsoft started flying up, so I've trimmed some of that position because I want to bring it back into check with, I don't want it more than 8% of my portfolio. So when something gets out of whack, right, I want a balanced portfolio. That's when I personally trim it. Some people are looking for a double or a 10 bagger. That's when they'll trim it. I'm really looking at percentage of my long-term investments. And that's mainly because I don't want to be beholden to any single stock. I think we've all seen, even Apple has had a 20% haircut on an earnings. Um, However, I will say the Warren Buffett approach overall is the right approach, especially for young people, especially for people that, want to make money over time. you want to be invested in really good companies and really good companies long term. So I've held Costco long term, Microsoft long term, Apple long term, and I trim them to get them back within that percentage again, but I rarely ever sell out of them. The only time I did that was COVID. When that whole downturn happened, I was selling more, but I was also hedged. So I was making so much money on the other side with my puts that I was trimming my stocks as it was going down. But, I don't recommend that. I mean, over time, stocks always go up. And if you're in good companies, then those good companies are going to keep going up over time.
How do you determine the good companies though? Because I mean, it seems like you listed stock, or you listed Costco, Apple, Microsoft. Obviously, those are some of the core stocks that people think about, right? I mean, obviously there's there's the FANG stocks at certain
Hmm.
points in time. Maybe those aren't performing. All of them are performing as well, but that was kind of like the mantra previously. Is that something that you kind of look at, right? Like maybe like some of the, I guess, big dogs, so to speak, the
Yeah.
top seven or whatnot. Is that kind of how you evaluate it? Or are you just trying to evaluate companies that, maybe you start to see pop up and, say, are doing great work, and then you see them all over. Maybe they aren't the biggest company, but you enjoy their product, that kind of thing.
So for me, honestly, it has to do with, I think, what are we using? What's my family using? Where are we going? And obviously, you need to have a company with a good balance sheet, right? You want to make sure that they have cash. You don't want to just be investing in a SPAC or some like, fly by night company. We saw what happened during that. You don't want to be just going to, indebted companies that literally have no cash flow and no runway, right? So that is important. But I also have a job. I'm a mental health therapist and a university professor. And so I don't literally have the time to be looking through, everybody's full on balance sheet. So I'm really looking at what companies do I personally use. I always have my ear to the ground, like with NVIDIA, right? Like, what am I seeing? I live in Seattle. We have so many friends and people in our community in the tech space. So I'm listening to them, like, what products are they buying, like for the gaming chips for NVIDIA or for the AI? I don't personally have a NVIDIA, I'm not buying NVIDIA chips, right? But I'm using the AI technology, and I know that that's what they're empowering. And I know that that's where a lot of my friends are investing because they're looking at the future and they're in that space. So, however, I do have stocks that are smaller positions. So if I'm looking more for a stock that's a swing trade, or for a stock, for example, like Rivian, I'm a big fan of Rivian. They have about a 2-year runway. I see them everywhere, and they have a mom car. And so, being a mom, you don't, a lot of these EV companies, they don't have that. I know it sounds silly, but I'm having to, have kids in tow, have their friends with me, but I'm also want to be environmentally friendly. So, I usually keep any more riskier position to under 2% of my portfolio. And with Rivian, that has been an amazing trade, right? What got me in that is I just started seeing them everywhere. And it started like, being like, wait, I'm taking notice of this. And I'm like, why am I seeing these cars everywhere? And so that got me to start looking at the company, finding out, how long their runway is with cash, that they're not going to fold overnight. That's my risky bet because I have about 2% of my portfolio in that. Some swing trades, I'm going to look up at my computer here. Some other swing trades I have is Target, because that got so beaten down. So buying companies, there was a lot of first of all, their margins were, crashed, right? Essentially because of the self checkout. They were having a lot of theft. And so they just had a horrible earnings season. And then also the political fallout um, also caused them to crash more. Now Target has been staying right about 130. I still love to shop at Target. Ulta has a partnership with them. My kids use Ulta, I use Ulta. And so when I saw it start stabilizing, I was already in a little bit, but then I decided to up my um, investment in it. And so that's not to me like a risky trade, so to speak, but it's more that buy companies when they get beaten down, when maybe they're overly beaten down and they shouldn't have been.
Yeah. No, I mean that makes a lot of sense. But as you said, you view Target, maybe as like a risky company, right? But I kind of want to dive into that statement a little bit more because you own Costco, right? Which is
Hmm.
your bigger, I guess, like core staples, so to speak, which is
That's my number one holding.
okay, that's great.
Yeah.
Yeah, good to know, which is like a consumer staple, right? And
Hmm.
obviously, Target is very similar in a sense, right? It's a consumer staple, so to speak, like Walmart, maybe in that same basket as well. But you said one of your consumer staples was Apple. Obviously, Apple's a big tech company, but generally
Tech. Did I
speaking,
say consumer staple?
no.
I
Uh,
meant tech.
yeah, no,
Yeah.
I'm kind of referring to Apple as more of a tech company because, and generally speaking, I guess the narrative around tech is that it's a little bit more risky, right? I mean, that's
Hmm.
you see a little bit more of the volatility, but you have it as like a long-term holding. So I'm kind of curious as to how, you necessarily view, I guess, more of like a risky, somewhat trade or a risky investment opposed to, maybe, I guess a longer term, safe quote unquote investment like an Apple or a Microsoft, although those are tech companies.
Yeah, no, it's a great question because if you think in like 2009, when the market crashed, there were a lot of safe, quote unquote, investments, such as like Bear Stearns. That was a 120-year company, as we know. And, my husband had actually worked for them. So in Chicago, a 120-year company, and they basically went to zero, $2, but zero overnight, right? So it's not like there's any safe company. No investment is safe. And however, it's looking at, like I said, how much cash do they have on hand? What are their sales? What is their gross margin? Who's investing in them? Do they have insider buying? I mean, when you look at the position Warren Buffett has in Apple, and how many insiders hold Apple. I don't know what the current figure is, but it would be probably hard. And you saw this in 2022. Apple held very well. Google went down 50%, Amazon went down 50%, and I think the drawdown on Apple was around 30, right? Now, how I'm managing those drawdowns though is I'm often selling covered calls against it. So I do sell covered calls when things get toppy up here. It's not going to completely protect my downside, but it's going to help me to bring in some income, not income, that's the wrong way to say it. It's going to help protect a little bit of my downside so it's buffering the loss, right? And also, I do what's called hedge wrappers when the market kind of gets toppy, where you sell a call, buy a put. So then I did that on Target actually. When I heard the news about Target and the um, political fallout, I just knew they were going to push that stock down. And at that time, it was almost 150. So I didn't want to get out of Target. So I sold a call and bought a put and essentially covered basically the whole downturn on that. So, but yeah, you can never be okay. A company to me like Rivian is risky because they don't have really more than 2 years leeway as far as cash goes, and they're not proven yet. Like, who knows how their sales are really going to go? Just because I'm seeing them all over the road, it's kind of anecdotal. Are they really going to be able to take on Tesla? Are they going to have the dollars and the manufacturing ability to scale to be able to make their trucks and mom car at the level to keep up with the demand? Right now, they can't. So, and then how much capital are they going to have to outlay to be able to build out those manufacturing facilities in order to be able to keep up? And their cars are fairly expensive. They're not, while Tesla was reducing their prices, Rivian has still kept their prices high. So to me, that's a more risky bet, right? They could literally fold and go to zero. I don't think if you're looking at it, the Apple's going to fold and go to zero. That doesn't mean they won't 20 years from now or 30
Yeah.
years from now. We've seen like Sears, Kmart, what else? Yahoo, not Yahoo, but AOL.
Yeah. No, I mean that's 100% right. I mean, like that's something that I guess kind of sticks with me, right? I mean, because like if you look at the companies like in the year 2000 compared to now, some of the biggest companies as like stock, I guess like the top 7 or 10 or whatever, the top companies that were in the S&P 500 at that time by market cap are almost not even really around, not even really name brands now. So I mean, as much as I'd like to think like, I'm going to invest in Apple for the rest of its, maybe its life. I'm also kind of wary that, at some point in time, that maybe Apple may get dethroned. Maybe there's some other smartphone that becomes, I guess, in a sense, dethrones the iPhone. I mean, I can't really foresee the future, but I mean, it is something that I kind of, keep an eye on, right? Because I mean, tech's ever changing. And yeah, as you kind of described it, right? I mean, some of these bigger guys have more leeway, but that doesn't mean another smaller player can kind of come in and, maybe dethrone the top dog, so to speak. So, but on that note, right? I mean, we do have kind of an interesting market dynamic right now, right? I mean, obviously we had we've alluded to it a couple times, but the COVID crash and like the run up,
Mm-hmm.
right? The kind of market hysteria that surrounded that, and we've kind of been floating around, right? I mean, we've had a few companies do really well, and then we've had a lot of the market kind of stay relatively flat. It seems, right? I mean, it seems like the S&P 500 is being carried by 7 to 10 ish companies, but obviously there's some that are doing better than others. So with that like outlook, right? I mean, you said you have cash, so to speak, on the sidelines, like
Yeah.
ready to be deployed, but also you're trying to
Yeah.
hold back on that. So, with a lot of like the potential macroeconomic factors, how do you look at that? Do you analyze anything maybe as to the CPI prints or the inflation or the interest rates of the Federal Reserve? Do you look at any of those things before maybe not trading on those days specifically on a CPI print, but maybe looking at that as far as like maybe a long-term investment? Do you look at any of these like kind of like macroeconomic factors prior to making an investment?
Yeah, for sure. Or that'll be one of the things that will cause me to put short hedges on, right? Like I might sell, like right now I have a couple of short NQs on to kind of because I'm so heavy tech to protect my tech side. Um, One thing just to go back really quick before I fully answer that. Um, in the 2000s, it was Sun Microsystems, Oracle, Qualcomm, and we don't know of Sun Microsystems anymore. Oracle's still around. Qualcomm, it took them 20 years, but even with Microsoft, it took them 20 years, at least a decade. That's not fair. It wasn't 20 years, but it took them a decade, 15 years to get back to where they were. So what I also like to do, and I think it's really important for anybody who's investing and isn't like a full-time trader, is I also have my 401k. It's all indexed. I don't trade it. I'll rebalance it sometimes. Like I put some in the Russell when the Russell went way down. You know, if people are new investors or they're, they're not taking advantage of their 401ks, the first thing to do is index because then you're not vulnerable to any single stock, right? As far as the macros for my trading account and my long-term investments that are not indexed, I do look at the interest rates. It's concerning when it's starting to go over 4%. I look at them every day. And so, yes, it gives me caution and pause. I won't sell out of my major positions, but what I'll do is I'll put short futures on. Right now, I do have some puts. I don't usually buy puts that often, but I actually did buy some SPY puts near the money for October. So I like to go about 90 days out on puts. And then if I lose that money, it's just the cost of doing business, right? I don't have someone managing my portfolio. So I have a certain percentage, like about 0.5%, that I'm like, I'm willing to lose this money, but I feel better having a hedge on. because I don't. So, and also I'm about 30% cash right now. And that's another reason why I'm not trimming my major positions, because I have so much cash on the side. That's a lot of cash on the side,
Yeah.
especially for a market that went straight up, right?
No, exactly. And is the reasoning you have, kind of the cash sitting on the side, like, is that because you're maybe more wary about some of the, potential macroeconomic fallouts that we have, right? I mean, we have like interest rate. Powell has come out and said he expects unemployment to go up. So almost like kind of hedging against, maybe a potential economic downturn, recession, depression, like, the terminology maybe doesn't really matter too much on like how severe it is, but that kind of like that's 30% is a nice safety net to have if potentially things fall apart.
Yeah, for sure. It's just like I said, I didn't recognize it was going to be a V-shaped recovery. So I think while it's really good to have cash on the side, and you can make great, you get paid 5% to have your cash on the side, right? Um, or 3 to 5%, let's say, depending on where you're putting it and what trading account you're in. At the same time, there's two sides to that story. When the market goes straight up, had I deployed that cash, I would have made more than it's sitting there, right? And so the whole AI theme, I wasn't expecting to take off and just have, and this is just a good lesson, right? Like it. So, but am I happy I have the cash there now? Absolutely. And I had taken that cash through some uh long puts that I had had during 2021, some of the shorts that I had, and also trimming during that time. And I just hadn't redeployed it. But am I nervous about some of the macro? Absolutely. I live with a perma bear. He was on the trading floor. That's what he did. And so, like, I live with a perma bear. And so I have to kind of balance it because he sees a lot of these macroeconomic factors. I'm aware they're there, but I can't like go all the way over to that side. So I just try to be balanced in my approach. And you're right, that cash is a hedge. And the thing is, though, most people don't get long when the market drops, right? I did get long at 3,500, 3,600, but I thought I was going to have more time. And so, I just think that's always the hard thing. That's why I guess you're looking to benchmark, the Qs or benchmark the SPY in your trading portfolio, not that you're going to like 5 times it.
Yeah, no,
The
exactly.
interest rates are concerning because
No.
they're at today. I'm looking up at my chart. That's why my eyes are up here. You got the 2-year at 4.7. That's where it's been hanging around. You have the 10-year at 3.85. It seems like when it's hit that 4%, the market is sold off. You have oil that has now jumped again. It's all up to 79. At least that's my futures. Uh, the oil, is running. Gold's kind of hanging around. So the question is inflation going to come rearing its ugly head back? And, there's signs that we really could be entering now into another inflationary period. Um, I don't really see that inflation is easing. I don't see it when I go to the grocery store. Again, this is anecdotal. I don't see it when I go to the grocery store, but even when I'm looking at commodities, they're starting to rise again, interest starting to rise again, and that's where these small businesses, your mid cap and small cap businesses, will have a hard time, right? Because how are they going to keep up with borrowing money, putting capital to work with these interest rates? I don't know, what are they paying? 12%, 11%?
Yeah, no, I agree with you. I think like, the interest rate environment is definitely kind of scary, right? I mean, we've already seen some bank failures because of it. And obviously there was, some mismanagement when it came to some of those banks, but that's neither here nor there, right? I mean, it was like believe like 3 of the 4 biggest bank failures in the past like 20 years happened within like a 6-month period, or maybe even a shorter period of time.
I know,
So
isn't that shocking when you think of Lehman and Bear,
yeah,
that these
exactly.
banks were bigger than that?
Yeah, and it seems like it kind of
It's
got swept under the rug. I mean, maybe
mhm.
just kind of maybe the Twitter era or the social media era where it's like, everybody kind of freaked out maybe for like a week or so, but it seems like nobody really mentions, Silicon Valley Bank or any of these other ones that kind of exploded. And we had like Janet Yellen come out and say that the banking system's fine, and luckily we haven't really seen too many other bank failures following that, right? I mean, we're seeing a lot of the regional banks maybe struggle, but it is kind of we've kind of alluded to, right? An interesting time as we're going forward, right? I mean, people are going to try to, predict what the Fed's going to do, the CPI print, and it seems like the market moves on everybody's kind of, the Fed's hanging word. So, do you kind of, I know you talk a little bit about like the swing trades and other things like that. Do you hold a lot of weight when it comes to, maybe some of these like Fed meetings, so to speak, right? I mean, because it seems like maybe more so a few months ago, but whether it was Jerome Powell was hawkish or dovish or one of these other bird metaphors, so to speak, of
Yeah.
like how he was kind of describing, as things are going forward, that would make the market shift, and it seemed like he had all this power. So do you kind of, I guess, look more so or try to predict, trade along that? Or, do you just kind of try to stay away from that because, I mean, it seems like Powell himself has so much power.
Yeah, I mean, I took off most of my options. I had options long positions, and I took most of them off coming into this week just because, I mean, it'll move like even when it hasn't moved, like maybe, you know, 4% or whatever, you're still getting these huge downturns, huge upturns, and the options prices will just go, you could lose your options dollars in like one day of PAL, right? If you're long. So I've kind of stayed out of that. I do have some long-term options that won't really be affected by the gyration of Powell's, speech. However, I am going into it cautious because people seem to not be listening or believing him. You know, they're that's what I hear, and that's what even the banks are saying. They've been calling for, or the market analysts, they're calling for rate cuts, and Powell keeps saying we're not doing a rate cut, and it's like they literally don't believe him. So I believe him. I don't think they're going to do any rate cuts, and if he keeps raising, I don't know what that's going to do to the market, but that's why I'm staying cautious, because if he keeps raising and he doesn't cut, my guess is the market will go down eventually, right? So I'm just keeping myself more neutral in the market besides my long-term positions.
Yeah, no, and I agree with you too. It seems like the market delusion is just always calling for this rate cut, but I mean, he's been, consistently kind of saying higher for longer, expect more pain, like all these kind of things. But the market, it seems like maybe it's just on fin to it too. But I mean, like it seems
No,
like everybody's
people don't believe it. Plus, he keeps talking about quantitative tightening, right? That they're going to take liquidity out of the market. But then what happened in the banking crisis? It wasn't quantitative easing, just like COVID wasn't quantitative easing, but yet it's providing liquidity. I mean, I don't know enough about economics and how the markets work, but at a very basic level, he threw liquidity back in the market, right?
100%, right? I mean, it was like, yeah,
That's
like
why it went like this again.
yeah, but it's exactly like you're describing, right? I mean, it's like it's quantitative easing, but they're just not really calling it that. It seems right. I mean, they're dumping liquidity into the market, and the market has kind of responded in a sense where it seems like it's there's like unemployment's kind of going up, inflation's still running hot, but it seems like the stock market is still performing very well. And it almost seems kind of like there's a disconnect between that the obviously it's anecdotal, but I'm noticing it as well too, right? That my grocery bill is still higher, gas prices still haven't really come down. To
Going out to eat, there's a
Yeah,
surcharge everywhere you go now, at least where we are.
no,
There's
same here.
literally a surcharge and then paying how much for the, not that I don't want to tip people, I do.
But no, I agree with you though. I mean, it's like, right. I mean, prices everywhere are still kind of going up and they're still elevated. And it seems like to me too, it's like, when the capital X expenditures of businesses, especially like, maybe like a consumer staple, like a Target or a Costco, for example, because, they're your holdings, right? I mean,
Mhm.
gas to transport all those goods and
Mhm.
whatnot into the store is more expensive. And, workers now, right? I mean, that there's increasing the minimum wage to $15 an hour. And I'm sure, like, the electricity bill, power, energy prices are elevated as well. So, that just to operate these storefronts it's more expensive.
Mhm.
So is that something that, I mean, or, and because of that, they've basically increased the prices of their underlying goods because they need to have those margins in order to be a successful business. I mean, that's just, the facts of the matter, right? So, is that something that you're kind of, I guess, almost like looking at when it comes to some of these consumer staple stocks that you're you're holding in your portfolio? You're kind of like looking at, maybe gross revenue when their earnings come out, and other things like that, to see, are people still, shopping at these? Obviously, the revenue is probably going to be a little bit higher, but, their capital X expenditures are still, are probably a little bit more elevated than, I guess, a quarter, maybe a year or two ago.
For sure, I think Costco's in a league of its own. It's different because of the, membership revenue, and the membership revenue that they take in is the thing that allows them to operate on a margin of 2 to 13%. So basically their, operating margin is between 2 and 13, right? Not that they don't have some goods that are higher than that. So really that's more of a membership base. If their membership was to go down, that would be a concern. At the same time, Costco's membership renewal rate has been stable for so long. So, and then also you get all types of people that shop at Costco, right? It's not just um you get a wide variety of everybody. It caters to so many different types of consumers, and that is sticky even in a downturn. And it does bring more people in when prices do get high, but it doesn't necessarily go away, if that makes sense. So I think they're kind of in a league on their own, A, because of the membership, like I mentioned, B, because they cater to a wide range of consumer, no matter what their economic status is. So I'm not worried about Costco. I think that it doesn't mean that their stock's not going to dip. I mean, it dipped to 406, a year and a half ago, and I bought more at that time. Um, I think they're good. Target, yeah. I mean, they're more concerning, I think, because price of goods going up, like you said, cost of gas to transport. But I think it's the smaller businesses that really are the ones that take more of the hit because they don't have their own depots and places to, hold the goods. They're not running their own fleet. Costco runs their own fleet. I don't know if trucking fleet, right? For sure, Target, I think it's a concern, and it showed in their last earnings. A lot of that was theft, but who knows how much of that was their gross margin shrinking.
Yeah.
And how much are the consumers going to be willing to take on these extra costs? The only caveat is, at least where I live, people still are not getting laid off. I mean, tech is booming here.
No, and I think, as we're kind of like looking at, right, the unemployment numbers, whether like, how reliable those are, I don't really know, but I mean the unemployment isn't really, I guess, like increasing
Mhm.
as much as Powell has kind of, hinted at that he's thought. So I mean, it does seem like the workforce is still pretty resilient. It's how much is that because of, maybe the gig economy and that kind of thing. I don't really know, but I think the whole like underlying consumer aspect of it is really interesting, and it's something to definitely keep an eye on, right? I mean, that's who's
Mhm.
going to start feeling the pain first is the consumer, and then it's going to kind of trickle into the businesses. For sure. So, but on that note, right? I mean, you talked about like unemployment, some of the macroeconomic factors. Like, what is the I guess outlook that you have for the rest of this year? Is there a specific sector that you're kind of keeping a close eye on? Maybe like looking at it to see like, hey, maybe it's tech, or maybe it's defense, or maybe it's consumer staples. Is there something that you think throughout the rest of this year that you're like I guess keeping a closer eye on than maybe you haven't been in previous times.
Yeah, I mean, I think what I'm really looking at in my area, and we're pretty close to the tech community here. I mean, our the whole every neighborhood around our area is employed by tech. And, Microsoft's they have uh, foregone some of their leases in like Bellevue, but their main campus there remodeling and expanding. Meta just came in here and they have I don't know, I think it's 100,000 square foot campus opening up soon. So I think once we hear that it starts hitting those jobs, and when I start seeing that people aren't going out to restaurants, even with all these surcharges, I mean, everywhere you go, it's crowded, right? And so it seems like the consumer still has a lot of dollars that they have in their pocket, whether they're putting it on the charge card or not. They're still shopping, they're still going out to dinner, they're still going to the movies. Look at what the blockbusters did this last weekend. Was the Barbie movie the biggest selling of all time?
Yeah, I believe
Was
so.
it?
Yeah, that and like Oppenheimer, like the
Mm-hmm.
combination of the two was like the biggest blockbuster weekend in quite some time.
I mean, you think of like two, when I personally think of like the great financial crisis, people weren't going out. They were losing their homes left and right. I mean, it was horrible. You saw it all around you. I think the biggest thing that's going to, and I know a lot of people have talked about this, so I'm not bringing up anything new here, is the office space. Because, for example, even with Amazon, they're only requiring their workers in the office 3 days a week into downtown Seattle. And so if the trend work from home sticks, which it looks like businesses are still having a hard time getting workers back into the office. Microsoft, it's optional, I believe. That's the question, like what's going to happen with all of those buildings and all of that real estate. And I do see a lot of for lease properties here when it comes to commercial real estate. So that's definitely a concern. And a lot of people are talking about it. Like I said, I'm not the first person to bring this up, but I can actually see that in my community. And we're more in the suburbs of Seattle, very safe, low crime area. And you're still seeing a lot of for lease buildings, huge buildings here. Like AT&T occupied a building here. They left, and that building's just standing empty now. But I think that's really the work from home, not as much as people are leaving this area.
Yeah, and I think that also puts like that's part of the reason why maybe some of the regional banks might be in some hairy times, right? I mean, a lot of these regional banks have loaned to whatever companies or whoever, maybe a mom and pop or maybe even like a more of a commercial real estate investing company to get these properties. And then these commercial properties are evaluated based on their rent, and if they're 50% occupied and they kind of got valued at 75 or even maybe even higher, it's going to devalue the property. I mean, we've seen it in
Mm-hmm.
San Francisco and in Chicago. I see a lot of these headlines of XYZ building basically getting cut in half from the amount that it's being bought for, and then people having to sell. So that is definitely a very concerning aspect of it. I mean, obviously we had 2008. It seemed like it was more of a, personal,
Housing.
yeah, personal housing, but
Yeah.
this time it could be, commercial real estate. That's the one thing that does really worry me going forward for sure. So, yeah,
And people, they say that, oh, well, everybody has these low interest rates, they're never going to sell their homes, which is true right now. But if people start losing their jobs, it doesn't matter whether they have a 3% interest rate or a 2.5% interest rate. And then the homes, there isn't a home around here under seven figures. You just can't find them, which same down in Silicon Valley, right? And so that means people were having to get, balloon payments. And yeah, maybe they could afford it at 3% when they had both spouses, both people in the home working. But that'll be a really interesting thing I mean, I don't want that to happen. I think, it's such a backwards way to say, let's lose jobs and put people out of work so we can bring interest rates down and depress the economy. I don't know. That's probably a whole different topic because then people go and they get on unemployment and then we're trying to not have the government like, whole can of worms. Doesn't make a lot of sense. But when we're coming to housing, I'm not saying it's going to cause a housing crash, but what will happen to housing if people do start getting laid off?
Yeah,
Because
for
they were
sure.
probably taking out balloon mortgages.
Yeah, and it's definitely, something it's something that can be a concern, right, going forward. So I mean, it's interesting how all these kind of markets are really connected, right? I mean, you can kind of just see it as you're lining out, right? I mean, it's obviously the underlying economy. So hopefully, we don't go down that like very bad dark path because that's never good for anybody. But at the end of the day, I think that there is some aspects here that of the overall stock market, the housing market, that kind of thing. Like I think like in the end, America is going to be resilient. I mean, I believe in the entrepreneur and the aspects of that here in this country. So hopefully things end up working out. But you've been very generous with your time, and I really do appreciate you coming on. So why don't you tell people what you got going on and where they can find you?
I'm on Twitter under Mama Vester. So that's MOMMAVESTOR. And I love psychology and trading.
Yeah, awesome stuff. So I will link your.
And you can hear us on Wolf on his spaces. Usually I'm on there 3 to 4 times a week, and you've been on there also. So
Yeah, great stuff. Yeah, yeah. I mean, I've just kind of recently gotten connected with Wolf, so hopefully I'll be on some more of his going forward. But
shout
yeah,
out to Wolf.
yeah, shout out to Wolf. Yeah, so he's been great. But yeah, definitely go ahead and follow Kim at Mama Vester. I'll link that in the show notes too, if in case you're struggling to find her for some reason. And
And
yeah,
I can send you I don't know if you want my Savvy Trader portfolio, but I could send that to you. Wolf and all those people are on it, and people can see what I'm invested in
yeah,
and
sure.
my performance.
Yeah, we can
It
link.
doesn't show options, and it only shows my performance since I started 2 months ago, but I've had the stocks a long time. But
Gotcha. Yeah, yeah, we can link that in the show notes too. So for those interested in looking at your actual portfolio, they can do that. So yeah, Kim, thanks so much for coming on.
thank you.